Hello, my name is Peter Petrov, and today I'll be talking about rental of vacation homes. This is for individual tax accounting, class 250, and today's date is October 21st. Today we'll talk about rental property categories, qualifications for personal use, primarily rental use, the primarily personal use, the personal and rental property, and finally we'll talk about the allocation of rental expenses. There are three categories of rental properties. The first one is a primarily rental use property. So if a property has not been used for more than 14 days or 10% of the total rental days for personal use, and it is rented for more than 15 days, then it's considered primary rental use. The second one is a primarily personal use. So if the property has been rented for less than 15 days, then you can categorize it as primarily personal. And the third one is the personal slash rental property. So in this case, if the property is rented for more than 15 days, for 15 days or more, and the personal use of the property is greater than either 14 days or 10% of the total rental days at the fair rental value. Here is an example given in the book. Uh, if Jose rents his property for 4 months and then he uses the property for personal use for 13 days, then this would be categorized as primarily rental days because he did not use it for more than 14 days. If he used the property for 21 days, then that would be categorized as a personal rental. If he rented the cabin for less than 15 days, then that would be categorized as primarily personal. For a dwelling to be considered personal, it must be used by the taxpayer, any member of the taxpayer's family, or another person with an interest in the unit. Also, any individual who uses the unit under an arrangement that enables the taxpayer to use some other dwelling unit, or any individual unless for such days the dwelling unit is rented for its fair rental value. If anyone uses the rental property free of charge, either family or non-family, then this is considered personal use. If any family member uses the rental property free of charge, then that is also considered personal use. Family here is defined as taxpayer's brother, sister, spouse, ancestors, and lineal descendants. I almost must mention that any day that is spent working on repairing or maintaining the property does not count as personal, even if there are other family members that are using the property for recreational purposes the same day. So here's an example. Javier owns a rental beach home. He and his two daughters spend 2 days at the beach house, where Nick repairs the deck and screen porch, while his daughters relax on the beach. The 2 days will not be considered personal in this case. For primary rental use, the taxpayer has to report all income and ordinary and necessary expenses. In addition, the portion of expenses that are allocated to the personal use are not deductible unless they're normally allowed as itemized deductions. If there is a net loss, it is deductible to the extent allowed by the passive activity loss rules, which is discussed in chapter 13, which we'll find about later in this course. For the primarily personal use, none of the income is included in gross income. In addition, no deductions are allowed for rental expenses, other than those that are normally allowed as itemized deductions. So here is an example. Kirk and his family live in Augusta, Georgia. And each year they rent out their property during a major golf tournament to a corporation for $10,000 for the entire week. Because this is only for 7 days, then this would be considered primarily personal because it is not, because it is less than 15 days. Therefore, they cannot report any of the rental income or the expenses. For the personal and rental property, taxpayers can deduct expenses only to the extent that there is rental income, and also there is no net loss allowed. So here an example given, Tex owns a beach house. Each year she uses her beach house for 4 months and rents it for 3 months. The property is considered personal and rental, and the expenses related to the beach house must be allocated between the personal and rental use. Remember that if the rental portion of the expense is higher than her rental income, the resulting net loss is not allowed. Now let's talk about the allocation of the rental expenses. For both primarily rental and the personal/rental, the expenses must be allocated between the personal and rental use. We are given 2 methods here. The first one is the IRS method. So in this case, the expenses should be allocated between the personal and rental days based on the ratio of the number of rental days to the total number of days. The second one is a tax court method, and the interest and taxes on the rental property should be allocated based on the ratio of the number of rental days to the total number of days in the year, and the remaining rental expenses are allocated using the IRS method. So the rationale here is that interest and taxes occur over the entire year, while the other expenses occur only when the property is used. Certain expenses are not allowed to be deducted, like travel costs and management fees. That is because they have no personal aspect to them. It's also important to know that tax court method nearly always results in a larger deduction for the taxpayer. So that's something we should keep in mind. And also, expenses must be deducted in certain order. So first, we must list the mortgage interest and property taxes, and then we list management fees, travel. Then we have other indirect expenses like utilities, insurance, repairs, and then we have depreciation listed last. So here is an example given to us in the book. We have 22 days for personal use and then 84 days for rented use for a total of 106 days. And we know that the IRS method takes the total number of rental days over the total number of use days. And that is multiplied by our expenses. So we have the mortgage interest rate of 1,300 multiplied by 84 divided by 106, we get 1,030. So that is going to be deductible in Schedule E, and then the rest is allocated to personal. Here is the example of the tax court method. So we have pretty much almost the same calculations, except the mortgage interest rate and the property taxes are divided by 365 instead of 106. So we have 84 over 365, and then once you multiply that by 1,300 to get 299 that is deductible in Schedule E, and then the rest is allocated to personal. So in conclusion, there are 3 types of rental categories. The primarily rental use, where taxpayers must report all income and ordinary necessary expenses. Primarily personal use, where none of the income is included in gross income and there's no deductions allowed. And then the personal and rental property, where you can deduct expenses only to the extent that there is rental income. Remember, no net loss is allowed. For both primarily rental and personal rental, the expenses must be allocated between the personal and rental use. They give us 2 methods, which is the IRS method, which is based on the ratio of the number of rental days to the total number of days the property was used, as we saw earlier, and then the tax court method, which takes the interest and taxes allocated based on the ratio of the number of rental days to the total number of days in the year, and then the rest are allocated using the IRS methods. expenses must be deducted in certain order, and then remember that certain expenses are not allowed. Thank you very much for listening to my presentation, and I hope you learned a lot from it. Thank you.